I'm going to take you through our view on global markets and Nigeria for 2023. Just a brief word of introduction. EFG Hermes is a leading investment bank specializing in frontier and smaller emerging markets. We've been active in Nigeria for coming on for 5 years now. I myself have been looking at Nigeria for around the same period of time, but my background is in Middle Eastern markets. I'm joined by three vastly more experienced colleagues today. Kato Okoro has already been introduced, our head of frontier research. We've also got Ronak Gadia, who specializes in banks in the Frontier University, leads our coverage on Nigerian and other sub-Saharan banks, as well as European banks. And we have Sarah Maha, who's a senior trader with EFG Hermes, who's been looking at African markets for many years, and before EFG was living and working in Nigeria. So, first of all, my job today is really to give you some context how we stand with global markets in 2023 and what that means for Nigeria. As you're all well aware, 2022 was a rough year for global markets, and I think that the key point here is that liquidity in global financial markets, not just in Nigeria, but across the globe, has been tightening. So I'm going to talk you through our view with a few slides. These will be shared with you after the event today, and please get in touch with us if you have any questions either now or later in the day. So I'm starting with a chart. There's quite a few charts in here. The point here is, if you look at global liquidity, and a way of measuring that is to take the Fed balance sheet, the US Federal Reserve System balance sheet, and then the reserves of all other central banks in the world. If you look at that combined balance sheet as a source of liquidity for the global financial system, you can see that it has been shrinking at its fastest rate since the 1980s. Why is that? Well, for one thing, as you know, the Fed expanded its balance sheet after the financial crisis in 2007, 2008. In the past few years, it has been running down that balance sheet. That process continues as it raises rates. At the same time, global central banks, particularly those in emerging markets, have been squeezed. They've been running down reserves, particularly with the commodity price shock that you had in 2022. Yes, central banks, particularly in emerging markets, they've also seen their reserves run down because of the commodity price shock. They're spending more on oil imports, food imports, and so on. If you look, for example, at the FX reserves of China, they've fallen from a peak of $4 trillion to around $3 trillion today. So that's a squeeze on overall liquidity, and that's affected the performance of global financial markets. So in the chart I'm sharing with you, you can see that until recently, the emerging markets index has been falling at a fairly rapid rate. It's just begun to recover. The liquidity environment has been challenging in a number of markets. What has that meant? That's meant that markets have become cheaper. So what I'm doing here, I've got a scatter chart showing the price to earnings multiple for a number of aggregates. So you've got emerging markets, frontier markets, Africa, ex-South Africa, and then some individual exchanges. And I'm plotting that against the earnings growth outlook. So Nigeria looks fairly cheap on this basis at around 10 times 2022 earnings growth of 50% plus. But it's not the only one that's cheap. Egypt also looks cheap. Turkey down below at a lower multiple, similar levels of growth. You've got Kazakhstan as well. China's quite a bit more expensive, which you'd expect for a market of that size. But many markets are cheap, and I think it's interesting that Nigeria last year sort of, and in 2021, missed out on a rally driven by rising oil prices. So if you look, for example, at the big oil exporters in the Gulf, Saudi Arabia, UAE, Kuwait, Qatar, those markets were very strong in the past 2 years. As oil prices rose, that liquidity fed into local markets. We didn't see that in Nigeria. As you all know, there was a failure of the high oil price to translate into sort of financial windfall for Nigeria. And that, I think, is why Nigerian stocks remained fairly cheap. So yes, there is a valuation opportunity in Nigeria, but it's not a unique one. So as I say, we've seen a bit of a recovery in the past few months. Why is that? Well, for one thing, I think China, the authorities there took some difficult decisions right at the end of 2022 to move away from their zero COVID policy. That was very successful in early 2020, but you saw in 2022 that it was remaining very disruptive, and political pressure on the Chinese government began to build towards the end of last year. They shifted their policy. They are now allowing people to move around more freely in China. Obviously, that's had an effect on COVID cases, but also it has now opened the door to a more normal level of economic activity in China. It will be bumpy, but I think that the levels of economic activity in China will be higher in 2023 than they were last year. And given the size of the Chinese economy, that's good for the global economy, and it's good for emerging market stocks. So you can see this chart I'm sharing with you that the green line is the MSCI EM index, which China is a third of. That's risen sharply since the lows in October, and flows into emerging market tracking ETFs have risen very sharply as well. So they're again spiking up. The average flow is running at around $400 million a day at the moment. There's also some factors elsewhere in the world. So I think that in Europe, for example, there's some optimism that the hit from high energy prices and from the war has been less severe than expected. Yes, everyone's expecting a recession in the US, but I think there's maybe some optimism there that might be a mild recession. Certainly expectations, I think, are better now than they were 6 months ago. So we've seen a recovery in money going into emerging market funds. That's good for emerging markets. What about frontier markets? So Nigeria fits within the category of frontier markets from the point of MSCI, which is the leading index provider. We look at a basket of frontier specialist funds, and they've had a rough few years. Frontier markets have fell a little bit out of fashion. What we saw, though, in the last couple of months has been some very strong flows into the frontier market specialist ETF, which is run by BlackRock's operation iShares. So just in the last 2 months, you've seen $240 million of inflows into that ETF, and I think that's driven by the fact that as I said before, valuations are pretty low. There's an opportunity in frontier markets as there is in emerging markets, and the flows into that ETF reflect that. However, Nigeria isn't benefiting from this flow into the iShares fund. I've got two pie charts for you on this slide. The one on the left-hand side shows you what this ETF owns by country. So the biggest country is Vietnam, VN, with around a third of that ETF being allocated to Vietnam. 4% of that ETF is allocated to Nigeria. So that's the ETF as it currently stands. But unfortunately, because of FX concerns in Nigeria and some other markets, Egypt, Bangladesh, Kenya, because of difficulties in getting foreign exchange out of those countries, any new flows into that frontier ETF that is now one of the largest vehicles for investment in frontier markets, Nigeria is not getting a single dollar. And so this speaks to a broader point about Nigeria, is that the valuation opportunity is clear. The broader sort of demographic opportunity, given the size of the Nigerian economy, the size of the Nigerian population, that also is clear. But actual investment flows into Nigeria are held back by the overvalued naira and the fact that foreign portfolio investors cannot get money out of the country. Nigeria is not alone in this situation. As I say, Egypt, Bangladesh, and Kenya are also not seeing fresh flows of money from this iShares ETF because of this issue. But it is a longer standing issue in Nigeria than it is in these other markets. As you may know, MSCI, the index provider, has been considering whether to remove Nigeria from its frontier index for some months. It deferred a decision on that until June this year, June 2023. So really, among the many pending items for the incoming government to deal with in the first half of 2023, one is the currency. Solving the current currency problem could prevent Nigeria being removed from the frontier index, and over time create more of a flow into the Nigerian stock exchange from foreign investors. Right now, those flows are obviously quite limited. What I'm showing you now is what frontier funds, this is a sample of 25 frontier funds with total AUM of $3.5 billion. What do they own in Nigeria today? Well, right now, Nigeria is just over 1% of their portfolio. 5 years ago, it was 6%. They are below the benchmark weight of 2.7%. And again, I think this largely comes down to the FX issue. The fall in the naira since 2018 has contributed to the fall in portfolio weight of Nigeria. But really, this is about outflows. This is about foreigners pulling money out of Nigeria because they're unhappy with the sort of current policy environment. Again, there's a clear opportunity for an incoming Nigerian administration to change the incentives for these investors and pull foreign money back into the market. Let's look quickly at local investors. You'll all be aware of the importance of the Nigerian pension system as a potential source of liquidity for the Nigerian stock market. It's one of the more developed pension systems that we look at in frontier markets. Morocco is probably the most advanced. Kenya also has a pension system, is under development. Egypt has nothing. A number of frontier markets have nothing in the way of a properly funded pension system. So Nigeria is quite developed in this respect. Unfortunately, the incentives are tilted against equity investment. And so it has to be a really compelling case for the Nigerian PFAs to put money into Nigerian stocks. This chart shows you the equity allocation relative to the T-bill yield. When T-bill yields collapsed in late 2020, there was a large increase in flow from these pension funds into Nigerian stocks. It came ahead of a dividend season as well, but when T-bill rates are zero, there's an enormous incentive to go into stocks. Now, with the recovery in T-bill yields in the past couple of years, I think there's less interest from PFAs in taking a long-term view and putting money into stocks. Why go into stocks for yield when you can get 14% on your local currency T-bills? Now, T-bills, as you know, have fallen back in recent weeks into single digits. We're also entering dividend season. So I think we may see some fresh interest from PFAs in Nigerian stocks over the next few months, notwithstanding the election uncertainty. But I think for the allocation to go back to where it was, let's say, 10 years ago, when these funds owned around between 10 and 15% of their portfolio was in stocks, I think you need to change the incentives for these PFAs, encourage them to look less at the short-term nominal return and really focus on what is the potential long-run real return from investing in equities. There's no secret, I think, about what Nigeria needs to do. I've mentioned FX a couple of times. This is a widening spread between the parallel and the official exchange rate. It's welcome, of course, that the official rate has weakened in the past year, but there's a lot more to be done. Again, there's a clear opportunity for an incoming administration to fix the FX problem, and in so doing catalyze investment flows from foreigners back into stocks and also back into fixed income. I think a key point is it's not enough just to devalue. You've got to have some other policies to enhance credibility. We've seen this in any number of countries that you can devalue in a crisis, but what you need to do is hard work, maybe on the fiscal side, so that people have more confidence in your currency. So that's a real challenge in the first half of this year. What to do now? Final slide from me is, I think really for portfolio investors, you should keep a close eye on yield. Dividend season is approaching. You have some good double-digit yields available in Nigerian equities. They've come down from the highs we saw a year ago, but still pretty generous yields available. I would focus particularly on stocks where you've got a decent chance of yield growth as well. You're entering a fairly disruptive period. The macro dislocation that may come in the next few months could affect the sustainability of dividend yields. So we would recommend at the moment Guarantee Bank and also MTN Nigeria as sources of relatively high yield, but also with fairly good visibility on yield growth over the next couple of years.